Hello, everyone. I'm Donna Hawley, the president of the Investment Institute, and on behalf of Andrea Zickethy and myself, we welcome you to the 5th session of our virtual coffee break series. We are delighted to see so many of our TII community signing in for each of these sessions, and we are so thrilled to welcome all of you newcomers as well. Thank you to our TII community for getting the word out there. It's such a great thing to be able to build a community online while we're still online and not in person yet again together. Today, we are very excited to have Simm, founder and CEO of Impax Asset Management, as the moderator for today's session with Rodrigo Garcia, Deputy State Treasurer and CIO of Illinois State Treasury, Kirsty Jenkinson, Investment Director, Sustainable Investment and Stewardship Strategies at CalSTRS, and Jani Shen, CIO at Global Alliance for Vaccines. We are particularly grateful to Impax for working to put this panel together, and we are thankful to our 4 speakers for contributing to our mission of education for our community. Ian will lead an interactive discussion and will leave time at the end for audience Q&A. So what we ask is that you please take a moment to locate the Q&A button on your Zoom screens, and while the panelists are speaking, please type in your questions as soon as you have them so that we can review them throughout the session and have more to cover during the Q&A time at the end. A quick note about your feedback. It really means the world to us, and it does to our speakers as well. If you could please take a moment at the end of our session, you will receive a link to a survey. Super quick questions, but if you would please give us your feedback, it helps us so much. Also, for those of you interested in CPE credits, 1 credit will be offered for today's webinar. Just please email us after the session for the details. And with that, it is my pleasure to hand this off to Simm. Thank you so much, Ian. Thank you all for being here.
Great, thank you, Donna. Hello, everybody. Welcome to the webinar. It feels like it should be an ice cream break rather than coffee break because I'm sitting here in London and it's been 90 degrees Fahrenheit today. In fact, in the room I'm sitting, I've got a little temperature gauge. It's about 88 degrees Fahrenheit. So if I'm looking like I'm suffering, that's my excuse. So it's ice cream break here, not coffee break. It might be lunch break for some of you, or even perhaps breakfast if you're out further on the East Coast. So yes, as Donna said, I'm Simm. I'm the Chief Executive of Impax Asset Management. So we're just going to do a very quick introduction with everyone, just doing a little bit of sound check and saying who they are. So perhaps Jeanne, you could just go first.
Yeah, absolutely. Can you hear me?
Perfect.
Okay, great. Right, so I'm Jani Shen. I am from GAVI, the Global Alliance for Vaccines and Immunization. And GAVI is a Swiss charity, but it's also a public-private partnership. And we work very closely with very well-known partners such as WHO, UNICEF, the World Bank, as well as with pharma companies, technical agencies, and civil society. We were started by the Gates Foundation in year 2000, pretty much to address the issue of vaccination rates moving in the wrong direction in poor countries. So that's what we've been working on for the last 20 years. We have a pretty big portfolio of vaccines, everything from DTP to rotavirus, pneumococcal vaccine, HPV. And of course, now we are involved in helping to get access to the COVID-19 vaccine with our partners once it is available. It's been approved and essentially certified by WHO. Our portfolio runs about 1.1 billion, so it's a bit smaller than the other speakers. We are also not organized as an endowment. So I would say, that's going to be different, or as a pension. So it's a little bit different, a little more liquid. Thanks.
Great, thanks, Jeanne. That's great. Kirsty, over to you. I think you've got the prize for the best lighting today, but tell us about yourself.
Yes, thank you. Hello, everybody. Nice to be with you all remotely. Thanks for the lighting. This is sunny Sacramento at about 102 degrees, I think we're heading towards today. So, beats London just for once. I am Kirsty Jenkinson. I work at CalSTRS, which is short for the California State Teachers Retirement System. We're essentially the public fund that looks after the pensions of California's teachers. We're about 245 billion in size in total. The team that I look after, we both manage an investment portfolio of $6.5 billion dedicated to sustainability-focused investments that meet the total fund's risk-return targets. But my team also leads our stewardship, which is our proxy voting and engagement activities on behalf of the whole CalSTRS fund. And we also monitor a lot of our discussions with our stakeholders who care very deeply, as you might imagine in California and amongst sort of the teacher base, about all the environmental and social and governance issues as well. So really pleased to be here today and looking forward to the discussion. Thanks, Ian.
Thanks, Kirsty. And Rodrigo, do you want to bring up the lineup?
Of course. Well, good afternoon, everyone. It's a pleasure to be here with all of you today, and hope to engage in a very thoughtful discussion. My name is Rodrigo Garcia. I'm the Deputy State Treasurer and Chief Investment Officer for the Illinois State Treasury, or the Treasury here in Illinois. We are the 5th largest state in our great union, and so we have a number of responsibilities here, not only the investments, but also the banking and financial activities of the Treasury. And so overall, I oversee a $32 billion investment portfolio, a $300 billion banking operation, and financial services activities, and then about a $4 billion agency budget. Overall, we have about 7 different investment platforms, some retirement, some non-retirement, some fiduciary, some non-fiduciary, some impact, some return-seeking, some investment pool-based, some open-ended investment structures. So we have a flavor from, on the very short end, all the way out to, private investments such as private equity, venture capital, and real estate. We serve the state itself, but we also invest money on behalf of local governments, and we also invest money on behalf of individual constituents who have money with us and money entrusted with us as well. And then as an aside, I also chair the investment committee for the endowment at Northeastern Illinois University, and then I also serve on the investment committee for the endowment at the Youth Guidance Foundation, both located here in Chicago, Illinois, where I'm joining you today. And then for fun, I guess I teach on the side at Northwestern University as well. So that's me in a roundabout, and look forward to a thoughtful and thought-provoking discussion.
Thanks, Rodrigo. That sounds like a very busy agenda. Just to complete the picture, Impax Asset Management is a firm I started in 1998, and we are investment managers focused on the transition to a more sustainable economy. So we have a strong belief that you can make great financial returns by investing in renewable energy efficiency, water supply, recycling, sustainable food, etc. We manage about $20 billion for around 80 institutional investors around the world. So turning to the subject of today's ice cream break, I think the title's a little bit optimistic. I think it's called Post-COVID, and I'm not quite sure we're there yet, but we did want to focus on what's been happening in the context of the crisis. It has been absolutely extraordinary, almost unprecedented in the nature of the calamity that we are still in. It's been an enormous shock, not just to the health of individuals, millions of individuals around the world, but also to livelihoods. And a number of us are concerned that this sort of twin crisis might be compounded by a third crisis, which is the permanent erosion of value for savers around the world, for pension beneficiaries, for those who have put money aside for the future. If those of us who are managing money don't do the right thing in the crisis, then we risk very seriously undermining that long-term value for tens of millions, if not hundreds of millions of people. And therefore we need to pay very close attention to how we're managing. So what we've agreed in the rehearsal for this break is a few sort of structured questions. So we're going to sort of anchor or frame the conversation around those, but to see where the conversation goes between us. But also, if you'd like to jump in with your Q&A, I'll try and weave in as many of those questions as possible. So just the first question is really just about your experience. What have you learnt over the last 3 months or so since the crisis hit? How's it been for your institution, and how would you say you're placed today? So perhaps, Jeanne, would you mind kicking off with that one?
Yeah, sure. Thank you very much. So, for us, I think, maybe as for most people, I think the velocity of the market movement was just pretty incredible. when you look back historically, you know, we looked over some major events, and really it seemed like the crash of '87 was the closest. I think that was about 3 times slower, if I may put it that way, from peak to trough, but this was just pretty incredible. So I think we do want to think about, okay, well, given, for example, there's just so much trading that's done, you know, electronically. You also think about retail investors, they just hop online and they can, you know, hit sell. With that kind of environment, you know, what can we do? And we do think volatility is going to be around, and that is one of the things we've been focusing on. You know, how can we manage that better in the future? And what are some strategies that would be geared toward that? So I would say that is a start for us. It was definitely scary, and I just think we have to prime ourselves for the future that that this is not a singular event.
And Jeanne, tell us about your GAVI's work in the search for a vaccine for COVID-19. You're in a pretty unique position to comment on that. So do share with us your insights.
Right, yes. So, you know, our focus is on poor countries. And so the primary focus of our work is to ensure that poor countries have access to COVID-19, the COVID-19 vaccine when and if it becomes available. Of course, you've seen all the news about, I guess I'll call it nationalistic tendencies, you know, countries that may want, you know, the vaccine for themselves to protect their own citizens. And so we are trying to create a sort of platform to help mitigate that event. It's not to say it won't happen, it may happen. I would say the good news is that, you know, it's pretty commonly known there are more than 120 entities working on trying to find a solution. And that to me is pretty incredible. And the other thing that's is just moving at such a quick pace is just getting the vaccine out there. Instead of focusing, you know, sequentially on getting a vaccine out, there are a lot of phases that are being done sort of simultaneously. But yeah, in a few short weeks, I would say just 2 months, we've organized a sort of a platform called COVAX, and it involves ourselves, CEPI, the Coalition for Epidemic Preparedness, and WHO. And what we'll be doing is to look at the candidates and figure out how we can allocate, you know, as fairly as possible. I will say a lot of details still need to be worked out. We just had our board meeting. There are a lot of questions. It was put together very quickly, and we are going to be having another meeting in July. And rest assured, our program folks, our policy folks are going to be working very hard to answer a lot of the questions that our board members had.
Well, we really appreciate all your efforts in this area where we really need your leadership. So please keep up the great work. Kirsty, CalSTRS is one of the largest pension plans in the world, one of the most sophisticated, a large team. I'm sure your risk registers are run to many pages. Where did pandemic feature on risk registers? How's it been so far? Tell us what you've experienced.
Yes, I mean, I think obviously pandemic was on a long list. It wasn't sort of like ever believed to be of this scale, of this kind of uncertainty. I will say one thing that I think served us very well was at the end of last year, the sort of the leadership of our investments team, we started preparing for a kind of liquidity challenge event. And we sort of realized that in the last crisis, we felt that we weren't able to respond and be sort of nimble enough. And so we kind of looked at, wasn't trying to say we were remotely predicting this. It just, I think, is fortuitous. But we'd spent a lot of time in the last couple of months just sort of saying, okay, when something does hit, not a pandemic, just perhaps sort of a downturn in the market after the bull run, you know, what do we need to do in order to be able to be better positioned? And so that really helped us, I think, to act pretty quickly. We were pretty defensively as a total fund going into the crisis, pretty neutral. But I think one of the things we really then focused on was trying to raise cash and have a buffer. that we felt we still have today that is important, because we just don't think we're through this. And the uncertainty rests with us, obviously, as we're all sort of saying. So I think that kind of team that's sort of coming together and working through this really helped us. And I think, again, in the dynamics as I look forward to where we now have a sort of healthier balance of cash, in this crisis and going forward, is much greater collaboration amongst our different asset classes. We're organized by each asset class, then reports into sort of our chief investment officers, and we sort of manage as a group. And I think what's happening now is kind of much more collaboration to say, well, how do we deploy the capital that we have into the very best ideas that we think are going to be most appropriate for the long term? And that's a much more sort of systematic approach. Normally we're quite allowed to be pretty entrepreneurial within the asset classes, but this has now led to a much more sort of top-down view on every sort of new investment really has to kind of like be thought through jointly as a group. Might slow us down on certain areas, we hope not too much, but I think that's been a real shift in sort of culture as well for us. For the portfolio that I look after, a really positive resiliency from our sort of sustainability focused public equity managers, and full disclosure, Impax is one of those. I think we've been extremely pleased to see some of those, the performance of these funds. And I'll happily talk about this later, but our portfolio, my portfolio, was in transition going into this crisis, as we're seeking to sort of pivot it, not just into public equity, from public equities, but across asset classes, because we think there are so many opportunities to invest in the solutions to a global sustainable economy. And so that transition is continuing. And I'm really happy to see, that has not remotely distracted us from this kind of need to kind of continue to build up the new portfolio. Just briefly, and if I may, on the sort of, I think the other side of this is, one is the investment side, the other is the people side, and just how do you actually get a team of, we're 175 people in our investment branch. We had pretty strict policies on not being able to telework or remote work. And then obviously in the course of a week, we moved all to everybody working off-site, and that's continued and is likely to continue from all guidance that we have pretty much through the end of the year. So I think we've been remarkably happy about how sort of resilience of people and individuals in this kind of time of crisis to sort of move remote. And obviously there's a lot of different management techniques and skills that we have to learn, to continue to support staff on that, but being really happy about how the use of technology, communication, and sort of behavior has really helped us, respond in a way that perhaps we didn't think was possible before this, but needs must, as we all know, and you do what you can, not least when you're wanting to secure the pensions that we look after and recognize the real world impacts that others are facing. Yeah.
Actually, you read my mind, because that was exactly my sort of follow-up question, was what has it been like for the people? But could you just say a little bit more about the sort of the day-to-day tactics that you and other managers have been using to keep morale high and check in on people? What sort of things you've been doing?
Yes, very much so. I think, clearly we all now know everything about Zoom that there is to know. This happens to be our sort of technology of choice, but it is, it's funny, you used to remember the days when you'd have a conference call and you wouldn't have video, and now the thought of that is so awful, because you get so much reading, obviously, from people, some seeing people. So I think we've all transitioned to this, Zoom environment with the lighthearted Zoom background shifts that you can have to kind of like make a meeting go in a certain way, or, create new discussions and rapport with your colleagues. I think we've been really focused on that sort of, much more intentional check-ins, much more intentional kind of understanding of roles, responsibilities, strategy setting. Everything just has to be, I think, clearly articulated, time spent, but at the same time, keeping those sort of personal relationships going as being quite critical, and that's a really important element.
Yeah, great. That's really interesting. And Rodrigo, tell us about your experience. You've got quite a complex organization, a lot of different clients. Just give us a thumbnail of how it's been.
Of course. So a couple practical items first. And so, as many are aware, when I say we, many governments began to see a decline in tax collections as a result of the diminished economic activity, increased unemployment rose, reduced consumer consumption, and a number of other activities. And so for us, it was about, at least on the short end, facilitating liquidity for the continuing expenditures that were needed in order to combat the pandemic. And so, starting back in early March, we began to increase the quality of our short end investment instruments. We shortened duration and we amassed cash to ensure that we did not have any type of liquidity crunch until any type of federal support arrived, which arriving sometime in April. And then secondly, we also deployed additional support for small businesses in the state of Illinois to the tune of $500 million in low cost / affordable loans that were in effect even before the CARES Act came into play. And so for us, it was about putting into place some of these practical items, including even deploying I think we went remote the first week of March because we had one employee who did test positive early on. And so as a result, much of the planning that we did in late February, it's when we started as an organization to test out our business continuity, get up our Bloomberg Anywheres, we had all these testing. And so when we had to go remote with 24-hour notice, many of our teams were actually ready and prepared. And I believe we went 99% remote within 24 hours. And so just from a few practical items, it has been very interesting to be able to ensure that our portfolio and our people were positioned appropriately, but also that we had the capacity to assist those communities and those in the businesses that were being hard hit by the impact of the pandemic. Now, with that, a couple of investment items I would mention. We did proactive outreach to our investment managers to discuss the impacts on the portfolios as well as positioning them moving forward. We had a number of conversations with a number of investment managers, whether it be BlackRock, McKay Shields, T. Rowe Price, Garcia Hamilton, but not just on the public side. We also did it on the private side with many of our private equity and venture capital managers to ensure not only business continuity among their teams, but to begin to understand the impact of the transition to sheltering in place, both economically, but also just from a people side. And given that private market investments tend to lag public, by usually 6 months or so due to the reporting, 3 to 6 months, we're beginning to see some of those impacts on the portfolio, coming through here in June, and we'll continue to see them in July and August as we continue to get some of those up-to-date reports. And, we still have a continued focus on due diligence and a continuation of our monitoring process, which means more conversations surrounding business continuity at the investment manager or the parent company. It's a heightened focus on financials and to ensure that the investment managers can continue to not only operate remotely, but depending on what's happening in the markets, and ensure, especially for some of our smaller investment managers, to ensure that they can continue to stay financially viable. And then ultimately, just acclimating to a more virtual due diligence meetings that are occurring via Zoom, via WebEx, via Google Hangouts, via Microsoft Teams. And I think we've been on almost every video platform that's out there conducting our due diligence remotely, because the work does not necessarily stop. And in some cases, we even had to work with managers to ensure that we were waiving fees for certain capital preservation investment products that are intended to preserve capital, whether that be a money market fund or anything else, to ensure that the fees did not exceed the yield, and ensuring that we were able to reduce or provide fee waivers. So any particular constituent that was in one of these platforms did not necessarily suffer actual loss of principal by being in the most safe and conservative investment vehicles available. And then lastly, we are a long-term investor, like many folks are, that are not only our fellow panelists, but could also many of you who are listening in today. And so, we're continuing to allocate capital on an ongoing basis, both on the public and the private side. Even in the current topsy-turvy financial markets, I understand that substantive yield is going to be very difficult to earn or to be provided across a number of asset classes. And so for us, our view is the next 20, 30 years. And so we're still allocating and making adjustments to our asset allocation, which ultimately asset allocation, at least for us, underpins our investment philosophy. And so having exposure to a wide range of asset classes that behave differently in different economic scenarios is going to continue to be our investment thesis, and we'll just make adjustments where, based on the correlation among asset classes on an ongoing basis. And thus far, we have been able to take advantage, based on some of these reduced valuations, especially in March and April and May, not as much necessarily today, but we'll continue to push forward and continue to keep a continued focus on our managers, both internal and external.
Great, that's fascinating. And tell us about how it's felt, just reflecting on the last 3 months. Have you been working incredibly long hours, evenings, weekends, more than normal? Has it been smooth and sort of calm within the team because you've had everything rehearsed? Has it been a little bit scary? Give us a kind of personal perspective.
Yes, that's actually a great question. I would say from a business continuity and operational piece, it was because we did a lot of proper planning. We had people working remotely to test out many of the equipment and many of the operations and procedures, and so from a business continuity was I would consider pretty normal, given the experiences that after talking to colleagues from around the country, the kind of experiences that they went through, obviously compared to say the experiences that we were in, say in January or February, it's very different. But I would say comparative, it was actually pretty normal. However, though, when it comes to the financial markets, that is probably where most of our, headaches and most of our consternation came from, because, you can't necessarily predict the financial markets. And so the markets were all over the place. And, the level of volatility that we were seeing, not only the spreads, but even the credit default swaps were just all over the place. And so for us, we were definitely working, I think many of our staff were working 50, 60-hour work weeks that did not include Saturdays and Sundays. For the teams that were working Saturdays, Sundays, we're putting in somewhere between 70 and 80-hour work weeks, coupled with, any personal aspects that many people have. They were taking care of their kids, they were taking care of their parents. People then, when they were exposed to other individuals who may have been affected, then they themselves had to become quarantined. So it was just, the confluence of a number of different items is what made this probably more unique than any other component, because we were dealing with, policy issues, we were dealing with social issues, we were dealing with the health of our employees issues, we were dealing with issues in the financial markets. And so I think maybe I would say like the first week of May is when we began to see it subside a bit and moving into like 60-hour work weeks. And now we're back to a more like a 50-hour work week. And so it's definitely become a lot more normal as we as a society not only begin to better understand the impact of the pandemic, but even more so as a financial market team began to understand the true impact on on companies' balance sheets and companies' earnings, and what that meant to our ultimate portfolio allocations and investment manager performance.
Yeah, wow. It's been a real test of leadership and systems and processes, hasn't it, for everybody? So thanks for sharing that. That's really interesting. So we're going to take a few of the questions that are coming in the next round. The next round is really about what have you learned? So it's probably a little bit too early to be doing a kind of end of crisis wash up review, but we are 3 months in, and lessons do need to be learned to make sure that we thrive and do the best we can in the next phase, whatever that might be. So Jeanne, would you mind just sharing with us what lessons you've learned as an organization, and maybe you personally, in the last 3 months?
Yes, I guess I would say one thing, maybe it's an overused sort of description, but I think you have to be really adaptable. I think you need to be able to pivot very quickly. And that's not just for this pandemic, but I think they're just going forward. You really need to think about that. So for me, it's just thinking about, okay, well, what kind of talent do I need going forward? You know, right now, you know, not just with the pandemic, but there are obviously a lot of discussions around diversity. And I think that's very important to really, you know, think about that, because it does bring so many new angles and so many new ways of thinking, which I find really helpful. I mean, I have a small team, but it turns out I'm the only team member that was born in the US. All of my other team members were born somewhere else. And it's been very enriching, and I would like to continue that. I think another lesson, which was just sort of reinforced, I mean, we certainly saw it during the Great Financial Crisis, but just that diversification works up to a point. You know, it doesn't work that well in something like a coronavirus pandemic. A lot of assets just went south. Now, we definitely had some strategies that did fine and did well, but yeah, there was a lot more correlation, and so we really have to think about, okay, is there really a way to dampen that? You know, how far can diversification go? And you know, I don't know that we want to go down the path of, well, definitely more complexity, because then that becomes an issue of liquidity. But we are looking at some, you know, for example, strategies that might involve some sort of public-private partnership. And if, you know, we go down the path that this country decides they really want to invest in infrastructure, for example, I think there could be some very interesting projects down the road. And I think for municipalities where, you know, Rodrigo mentioned that, okay, we're not getting the tax revenues, they're going to have to be very, very creative, very creative. And I think we'll see some very interesting projects come from that end. And I guess I would say, you know, you always have to revisit your managers. This was a really good test. You know, we obviously had, you know, due diligence visits, and, you know, we do something that's called a quarterly compliance questionnaire. And we will ask about, you know, business continuity issues every once in a while. And of course, you know, our managers answer, and we get varying degrees of, you know, depth. But this really was a good test of, you know, did their answer match what we experienced? And I think the good news is that, you know, our managers were pretty well prepared. So we were happy about that.
You haven't fired anybody as a result of their behavior in the last 3 months yet?
No. I will say someone who was put on our watch list is, you know, I think it could be a challenge. Not really because of business continuity, but partly because we're not sure how quickly they can recover.
Yeah. Okay. Great. Well, thanks for sharing that. Kirsty, what have you learned? There's a couple of questions coming in, just picking up on your comments about the adjustments in the portfolio that you referred to. So perhaps you could talk about lessons learned, but also just keep going about the changes you've been making.
Sure. Lessons learned, it just sort of feels like it's every day is a new learning, doesn't it? Because you get more information, you get new information, or the information changes, the situation changes. So it's certainly not static, is it, our environment at the moment? And so I suppose I'd piggyback off what Jeanne was sort of saying, and this sort of sense of adaptability, but it's also, how do you manage expectations? How do you manage individuals? How do you manage money in a time of, you know, constant shifts? And that's been the sort of the lesson learned is every week it seems like you have to manage expectations slightly differently. And so you have to be so transparent in your communications, I think, both from sort of our leadership at CalSTRS down to me, and I'm talking from our CEO and the amount of town halls we've had, but also me with my team and my peers as well. It's a sort of sense of, you know, the minute we do get some kind of new data information point, whether it be investment regarded or just how we work, how do you process that? How do you determine whether you're going to respond to that? because you think it's a long-term trend that you need to adjust to and fill people into, or is it just a rumor, or is it just hearsay, or is it just a sort of, you know, you're trying to guess the future? And I feel that's been the huge behavioral change, is just getting much better at balancing how to respond to very different incoming information, and then know how to sort of spread that in a way that doesn't create panic, but creates calm, creates sort of consistency, but creates transparency. And that's sort of been the tightrope, I think, that we've been sort of better learning to adapt to. But part of me is, you know, in all of this, and something I try and do with our team is like, wow, this is such a great learning experience for everybody. We better make the most of it. And whether it's having time to reflect, or whether it's, as Rodrigo says, you know, we've all been working longer hours, so you just try and be more efficient. You know, we will hopefully always look back on this at some point in our lives and say, it was a terrible situation, but we learned, and we're stronger and we're better for it. And I feel like as long as I have that as the kind of like the light to keep us going, that gives me sort of real confidence that we have a goal to work towards. Another quick point on lessons learned. I suppose I'm really a bit naive on this, but sometimes how market behavior can be so dislocated from reality. Again, this sort of the markets, we didn't think they would bounce back. We didn't think, who knows if it is a V-shaped recovery, but at the moment, you know, we didn't think it would. But more to me, from the role I sit in as well, is like, wow, you think about the impacts on supply chains, on workers around the world, on the least developed countries and emerging economies, and they're so profound yet, and yet that's not sort of being priced into how we see the markets recovering today. So I haven't obviously learned that lesson, that this disconnect is really broad and wide, and I really makes me question as we go forward, both what it means for us as an investor, but both what it means for us wanting to seek, you know, truly sustainable world growth. So I'm sure, Ian, you have some reflections on that would be really interesting to hear a perspective on, but that's something I feel as well. Trying to quickly, but not monopolize the discussion, a couple of questions that I see coming in terms of I mentioned that the portfolio that I look after is seeking to expand our investments across other asset classes, away from, in addition to our current investments in public equities. Clearly, that is requiring a lot of coordination with the current asset classes that have obviously the risk return parameters set up for their particular areas. I don't see the role of my portfolio deviating from, again, what they would consider to be acceptable risk return parameters. It's more about maybe their benchmark, the size, their concentration that they already have to a particular area is sapped out. You know, this is where I would hope that the investments that I can make, particularly focused on sort of sustainability solutions, can both add to it has to add to the fund's total risk return sort of overall structure, but it just might fit perhaps in mine better than it does elsewhere. So there's a lot of discussion going on about how do we manage that from a sort of a total fund, and how do the asset classes play together. And then the other question, I think, is are we focused on impact, and is that sort of what's driving the transition? It's an interesting question. We're a little, I don't particularly look at my portfolio that we're seeking to develop being an impact portfolio. I do say that we seek to create demonstrable environmental, social and governance positive outcomes. Maybe I'm passing words a little bit. I still feel that when you use impact, certain people define it in other ways. And so there's a little bit of complexity around that. I would say more that we're very convinced at CalSTRS that the shifts affecting the global economy and are shaping sort of the worldview that we have are being driven by sustainability factors. And therefore, in seeking to invest in solutions to those sustainability factors, whether it be climate change, whether it be the need for increasing amounts of affordable housing, all these issues, we just think that there are huge investment opportunities that will both have a demonstrable impact on the sustainable economy, but also be really positive to the risk return profile that we're seeking to achieve. So I hope that touches, sorry, I'm going a bit quickly through those on a couple of the questions I saw. I'm happy to come back to them if we have time.
Yeah,
Does that sound all right, Ian? Perfect,
thanks, Kirsty. And Rodrigo, how about you? What have you learned both personally and as an organisation? There's also a question coming for you about whether the pandemic's an ESG accelerator or not. I'm not sure you've seen that, but
So COVID-19 has exposed major weaknesses in our system, and that impacts investors. For example, worker protections. You know, COVID-19 has shown that many companies do not have appropriate worker protections, and that can impact their operations, their productivity, their reputation, and their brand value. We've seen many warehouses, we've seen many companies shut down because the inability to protect workers has then led many to be infected. And we've seen this whether it's from, in manufacturing to food processing plants and so forth. And that has a risk of not only lawsuits and additional, government regulation and labor conflicts, but ultimately it's higher turnover, it's productivity losses, it's loss of revenue as these companies have had to shut down. And, and it kind of goes into this other notion that companies are also facing some major supply chain disruptions as they cannot get their products or services they need to run normal operations. And we've had a number of conversations with both public and private companies. And I won't necessarily get into the specifics of which companies they are, but we are definitely not out of the forest yet. There are still many companies that even before some of these spikes in infections we started seeing yesterday and today came into bear, that many companies were going to face many supply chain disruptions as a result. And that obviously then has loss of revenue, market share, reputational risks. And so for us, I think it's something that we already knew that was material and relevant, but it's only brought to light not just to those, to just certain investors, but across all investors. And I think there's a groundswell of interest and support by a number of stakeholders on these issues right now. I know that a number of institutional investors ranging in the trillions have been trying to assess the situation and get a better understanding of the impact overall, and not just from the investment standpoint, even from the companies themselves, that they try to make their companies and their operations more resilient in the wake of COVID-19. And so I think, if anything, it's heightened the importance of having a strong corporate governance structure to ensure that there's accountability, that there's transparency, that there's policies and processes, and that there is a clear delineation of responsibilities when it comes to being able to set up the structure, the business continuity structures. And I think early on, especially in March and early April, many companies were caught flat-footed and were unable to have any substantive percentage of their operations continue to move forward. And so, but I think since then, we've seen those companies that have those strong corporate governance structures, public and private, and those who do not. And those who do not, some have begun to make adjustments, and others, unfortunately, will fall by the wayside because they did not have those business models that accounted for these type of scenarios. So that's kind of the major thing that I would say. And then related to that other question on ESG, I'm happy to answer it as part of the next component, because I think it hits directly into some of the things that we're tending to look at. But I would say that, if anything, is only going to accelerate this transition into sustainable investments, which is, to Chris's point, is very different from impact, and is very different from socially responsible investment. Sustainable investment is just a pillar that should be looked at just like many other things that we tend to look at, whether it's management, whether it's business model, whether it's industry and sector, whether it's fees, whether it's revenue growth, and many other pieces. And I believe in due time, sustainable investment and regular investment are going to fuse and just going to be known as one, and it's going to be just a pillar of investment strategy and investment thesis overall.
Right. Yeah, I would fully agree with that. I think it's really helpful to remind us what's really going on in real companies, and how governance is a crucial factor of survival. So we've got about 5.5 minutes left until we need to wrap up. So maybe just turn to the final section, which is all about the future. So it might be a little bit too early to plan for post-COVID, but clearly we're all paid to look at the future and try and map out strategies for being successful. Jeanne, tell us about GAVI's plans for the future. How have they been affected by the crisis, and what's your current thinking? So just a few brief remarks would be helpful.
Yeah, sure. So future, there have been some remarks about due diligence, and well, for one thing, there's limited travel, and so it's going to be hard to go on site. And I think just any investor probably has at least one on-site visit before they hire a manager. And now it's unclear if that's feasible or advisable. And so I think you really do have to figure out, okay, how else can I conduct this due diligence? But I also think it's now you being a manager, I think also managers could, you know, maybe provide more information about, I guess maybe what we might have observed had we been at your office. So some of the, I don't know, the soft sort of statistics or the soft observations, if you will. So, you know, I find when I go to manager, okay, yeah, I am looking, okay, how diverse is it? Are there senior women as investment professionals, et cetera? What's my sense of, you know, the camaraderie, et cetera? You know, I wonder if managers can somehow put that forth, you know, and make it easier for investors like, you know, GAVI or CalSTRS or Illinois to discern that. I also think there's an opportunity for investors to share more information with each other. I really would like to see that. And again, the managers may be able to help facilitate that.
Yeah, great.
So, yeah.
Some challenges for managers. We'll try and respond.
Okay, all right.
Kirsty, clock's ticking, but a few pithy thoughts about the future.
Yeah, lots of things. I sort of put it in, you know, there was a lot of change going on, I think, at CalSTRS and then my team even before this, and that sort of being, as I sort of hinted earlier on, accelerated, I think, really focused on future priorities. I think, you know, back to what I said about being really intentional about what you are focusing on in this time when everything seems to be coming at you and the world is changing and the markets are shifting. You need to be really clear about what your goals are and the priorities to getting them. So a lot of focus on that sort of intentionality. New skills, really grown our investment team, and even my team is sort of, you know, I'm looking, just even preparing for this panel, I realized that there'll be, out of a team that will be 20 next month, there'll be 9 new members, including myself, over the last 18 months. So, I mean, that's a huge shift in terms of how you know, a bunch of new skills and a whole new team to create. New relationships, both internally and externally. I think that's really critical. New partnerships, how we're investing at CalSTRS is changing, very much sort of seeking to have more control internally and more manage more assets internally. So that's a big shift that we're also focusing on. And then I'd also say, just on the engagement side, how we're engaging companies, I think really kind of amplifying our leadership in encouraging companies to sort of focus on the now, the business continuity, the kind of the employee health and well-being, but they're kind of like real alignment with long-term value creation in the sort of the economy that we want to invest in. That's a huge focus for us going forward as well. I'll leave it there.
Yeah, perfect. Thank you. And Rodrigo, can you wrap up for us?
Of course. And so I'm gonna say this in the framework of not just COVID-19, but understanding in light of what's happened in the last several weeks of the inequities that exist in our society, and the role of asset allocators and the role that finance plays in the allocation of capital overall. So with that, you know, the moment now and then here moving forward has only validated, at least for us, our sustainability and ESG assumption. You know, I think COVID clearly demonstrates that the way companies address long-term sustainability issues will impact their resilience and long-term performance. COVID-19 would lead, at least in my opinion, will lead more institutional investors to commit more capital towards sustainability, given performance and evolving stakeholder attitudes. When companies do things like increase healthcare benefits, hike pay for workers on the front lines, lower executive compensation to help avoid layoffs, take extra steps to protect worker and customer safety, they will only benefit from having a more engaged and productive workforce and a more loyal customer base following the recovery. But at least the impact has been severe. It's been widespread. There's a public health crisis. We've seen short-term food shortages. We've seen rise in unemployment, loan defaults. The very fabric of our society is at peril, as exposed issues of race and ethnicity, of age and class inequality within our humanity. Our economy and the people within it are not immune to these challenges. And just as the pandemic has exposed these inequities within our civic society, it is also revealing the risks within our local economies and our local communities. The speed and the scope of this downturn is significantly worse than any recession we've seen since World War II. You know, when a whopping 40% of families who have lost their job are those who are earning less than $40,000 a year, it means that those citizens who are most in need are bearing the brunt of this academic shutdown, and it's putting the cost of not having a social safety net front and center. And so, you know, although many people will suffer as a result of this crisis, people of color are particularly vulnerable because there has been the COVID-19 has not only ravaged Latino and African American neighborhoods due to chronic health disparities, but job and wage losses have hit these communities the hardest. And so the response to the pandemic, at least in my opinion, is being impacted by the same trends that have impacted many of our lives. You know, growing income inequality, the rise of misinformation, the lack of trust in institutions, the rural-urban divide, hyperpartisanship. And I don't believe this is a Republican or a Democratic issue. This is not a rural nor a urban issue. This is not an issue of us versus them. This is an issue of humanity. So I hope that as we continue to push forward, we drive change towards a free, just, fair, and equitable society. The work is more important than ever now. We should seek to work in partnership to address and rebuild our communities and address the historical and structural inequities that have persisted in our society in light of the new and evolving challenges ahead. And I believe allocators and the world of finance has a key role to play in it. And I hope that people take a proactive role and not necessarily one that is reactive and or passive.
Rodrigo, those are really powerful words and a very appropriate note to finish this discussion on. So thank you for that contribution. I'm going to head over to Andrea just to wrap up, but just finally, thank you to all the panelists for their contributions. And over to you, Andrea.
Thank you so much, Ian, and for the ice cream break, which is great, and for staying up later and doing this past dinner time. Rodrigo, Kirsty, Jeanne, this is just great. This was amazing, and we are so grateful to have you for the first time involved with one of our sessions. And I have to say a shout out to our really good friend, Chris Bull. I know you're on there, Chris, so thank you. Chris is with Impax, and he helped us get in Ian, and he helped us, he did all the legwork, came up with the idea. So I really wanted to, thank you on behalf of Donna and I. Just a few things for upcoming. You could see this slide. We have a virtual session on July 16th, and we will announce that session shortly. You'll receive that via email. We also have an asset owners one for all of you who have emailed. Please get back to me. And if you didn't receive an email and you'd like an invitation, let me know. It's on Tuesday, July 14th at 2 o'clock Eastern Standard Time. And that's for CIOs or senior investment professionals from either an endowment, foundation, hospital, pension, or single family office. But lastly, I'd really like to tell you, when things are uncertain, but we are going to try, and it might change. But as of right now, we are releasing our renewals for membership and registration. We're doing an outdoor open air forum on October 26th to 27th. We've moved it to North Carolina, back to our home area where many of you can drive to. So we hope you can come. That picture of the Angus barn, all those walls open, they'll be open air flowing. We'll have everybody lined up outside. It'll be a fun event and socially distant, and we'll do it properly. What's really exciting is that we were able to commit Dr. George Friedman just yesterday, and he will be there for the asset owner discussion. So there'll be a nice small group of asset owners for lunch. George will be there to be in on that conversation, and also keynote the event and open to the whole audience. Ted Seides, who you all know from Capital Allocators podcast, he'll be there, and he'll be interviewing some large allocators on stage about what everybody's doing with their portfolios, and hopefully we'll be a little bit more post-pandemic by then. Angela Lee is wonderful from Columbia, and she has spoken for us before. She's incredible. You'll love her. She's going to do something on venture capital and startups. And Frank Abagnale is he's very famous. They wrote the movie Catch Me If You Can about him. He was the subject, and he will speak on cybersecurity and a little bit about his life. And so that's it. That's what's coming up. We're so grateful to all of you panelists, to Ian, to Impax, to Chris, to everybody. And we can't wait to see you in person again. And if not, we'll see you again on Zoom. So everybody be safe, and thank you so much for participating. Bye-bye.